Welcome to TheoTrade and the weekend update. This is Don Kaufman. Here we are. It is October 22nd, 2016. I'm going to start this afternoon by looking at the S&Ps, and we'll look very careful here. This is a 90-day, 3-hour chart, which really defines what started kind of mid-July as months of channeling and literally trading from level to level. So one thing I've been talking about extensively lately, and I'll come now into a little bit of a tighter time frame, is how every day for the most part we're waking up into what is a binary trading day. And that basically means it's flip a coin, which, hey, you can make an argument that's any given trading day, but you flip a coin when you just bounce from level to level. Well, this past week was nothing different from that. We just kept going, and again, those levels that we've mentioned time and again from 21.29 back up to roughly 21.43 earlier this week. We threatened to go lower. Ultimately, we found the 21.29 level, took back off to the upside from there, but rather light trade throughout the week. However, in this weekend update, I want to take a moment and look at a couple of previous earnings announcements, because there's a trend going on right now that frankly I've never seen before in trading, and I want to bring it to everybody's attention prior to some of the big earning releases. Of course, we have Apple coming this next week. All right, there's actually some big economic events this week too. There'll be some GDP towards the end of the week. Nevertheless, let me spend a few minutes talking about earnings from this previous week's trade, and I'll start and kind of kick it off with Netflix. All right, so let's go to a more normalized chart over here. Netflix having an explosive move on their earnings, okay, Monday night. But what does this really mean for you, and why do I want to take a look back at previous earnings announcements? This has a tremendous amount to do with what we term expected move. And if you've never heard that term before, in any given product, in any given day, you'll look, for example, and we'll just go to an option chain here on Netflix, and I'll open up the options chain, tighten up the number of strikes here, and we'll go take a look, okay, at the right-hand side of this option chain where it says $5.78. Now, what that expected move is it a calculation proprietary to thinkorswim? Sure. But what the expected move really comes down to, it's just taking the implied volatilities of these options, okay, averaging them together, dividing out by the number of days remaining to expiration to ultimately come up with an expectation of movement. Now, there's absolutely no directional bias to this. So if it says, up $5, it's the same probability of going down $5. And another way you could look at expected move, all right, here's Netflix trading at $27.50. You could look at what's termed the at the money straddle. Now, what's the at the money straddle? Well, just add up the at the money calls in this case to the at the money puts, and here, take a look. Ironically, the at the money straddle just so happens to be trading for $5.39. Well, the expected move for the next 6 days happens to be about $5.78. So there is a little bit of difference between the at the money straddle and this calculation that's here on thinkorswim. But all right, give or take a few pennies, the at the money straddle is really close to the expected move. So when you look at these calculations, you don't think of them like, hey, the market, it's wrong. Listen, the marketplace is just that. It's the market. Who sets the market? You do. Everybody in the world, if they want to buy Netflix options, they buy them. If everybody in the world wants to sell Netflix options, they sell them. But what happens to pricing? If everybody goes out and buys, pricing goes right up, right? Implied volatility would increase over here. If everybody's a net seller of options, the price of those options goes down. So really, it's the market that sets the price out there. This is no longer a couple of market makers, standing on a floor trying to figure out, the skew and the kurtosis out there. This ain't the 90s, all right? This is tens of thousands of market participants putting in bids and offers that really derive markets. Now, Why is all of this important? Because we're going to look back at a few earnings announcements, and I'm telling you, sometimes spending a little bit of time, okay, doing just some quick and dirty research, it's not just going to save you money, it can make you a lot of money. And that's what we're going to look at here. So first and foremost, I want to take you into what is called Think Back. This is just end of day data, okay? It's end of day data right here on thinkorswim. And the only reason, again, if you don't have thinkorswim, that's fine. But what I'm taking you in there to see is what the expected moves were prior to the earnings announcement. In this particular case, and I'll start rather slow with Netflix, okay? This is what? It took us back to a date of October 17th. It was this past Monday. It was a lovely Monday afternoon. Yeah. Well, the expected move was about $11. That was at the close. So what the server does, all right, here in Think Back, it just takes a snapshot right at the close, right? The very next day, what happens? Boom! Netflix earnings come out. Now, this is the end of the next day. It's not in the morning. It's the end of the next day. Netflix smokes through its expectation of price movement, almost doubles it. So what do you learn from this? Well, I'll tell you what you learn. If you sold options coming into Netflix earnings, you probably learned you are not a happy camper. All right, so Netflix is one that clearly moved outside of the expectations. Next, let's go to eBay. All right, and we're going to speed it up as we start to go through eBay. When did it come out? When did it come out? I think it was October 19th. October 19th, if you take a look, there's a $2.58 expected move. All right, I didn't set it. This is not a calculation that set it. This is a market that set this price over here. Look at the at-the-money call, the at-the-money put. Great. What happened to eBay the very next day? Oh, down 350. So what did it do? Moved outside the expected move. So if you sold options, are you a happy camper? No. All right, next, let's go take a look at IBM. All right, and these are in no, certain order over here. When did IBM have earnings? IBM. Also on the 17th, it came out just about the same time as Netflix. So IBM was expecting a $6.21 move. It doesn't say it's going to move $6. It's supposed to be, okay? The way these expected moves, it's supposed to stay in this $6 range. So up $6 or down $6. IBM being, for instance, $155 product. Well, what really happened comes out, woo, look, it's inside the expected move. But I will show you, during the trading day, it traded, albeit briefly, outside the expected move. So what do we find out about IBM? It was right on the margin. It was on the margin of the expected move over there. Okay, so we have Netflix outside, eBay outside, IBM marginal. Marginal, it really was. Let's move on. Intel. Okay, what do we have for Intel? Well, is this the right date? Is this the right date on Intel? Yeah, it was on the 18th over here. It was looking at about $1.36 expected move. What happened to it the next day? $2.24. Clearly outside the expectations of movement over there, right? We're having a party now. Let's go over to the next one that came out. And again, I'm only putting up here fairly liquid products, stuff that's moved. Let's go to the 19th. There it is. We are on the 19th. The expected move is $2 and what? Oh, $2.45. Fast forward the next day, thing moved $5. 2 times the expected move. What do you find about American Express? Outside. Okay, let's go to another one. All right, here's a boring one. Nobody even cares about Verizon. Nobody cares about Verizon. But Verizon, let's actually price it here on October 19th. October 19th was looking at $1 expected move. Oh, that was going to be exciting. It moved to $1.24. It's outside the expected move. Right? Wait. We ain't done yet. We ain't done yet. Let's go over to Microsoft. Now, Microsoft's interesting because it's one of the most liquid products in the entire industry. Hands down, it's one of the most liquid products in the entire industry. Microsoft, here it is on the afternoon of October 20th. All right. The very next day, what did it move? $2.41. Wait, you got to look at that one for again. It was expecting a $2.43 move. What did it move? $2.41. On it, baby. On the expected move. The most liquid product pretty much that we've looked at thus far happened to be on the expected move to a T. Now, last but definitely not least, let's look at Mickey D's. Mickey D's is another one where it saw some pretty serious volume out there prior to it, but What was Mickey D's looking like? So here's Mickey D's once again on October 20th. It was looking about a $3.38 expected move. What did it actually move? Oh, $3.36. It's amazing. Smack on it. Why am I running through all of these? You know, I could bring up GE, I could bring up AMD, not as liquid, but what I wanted you to see, we really only had like one product that was inside of the expectations of price movement. Everything else was either moved to it. And by the way, the only product that moved, it was IBM. IBM was the only product that moved kind of like to a T onto the edge of the expected move, or really inside it. Moved $4, expecting a $6 move. Everything else, like Netflix exceeded, again, eBay exceeded, IBM again was inside, Intel was outside the expected move, American Express was outside, Verizon over there. What is it telling you? If I were you right now, I don't think I'd want to be a seller of options premium coming into the earnings. Now, we're going to see the likes of Apple this week. All right, Apple's going to have earnings, and it's one of the most liquid products out there. But I have to tell you, it's not often that I'm going to say something like this in a pretty bold statement. The market is getting it wrong. This is not about some equation, anything like that. I have to think that there's so many premium sellers out there that ultimately, all right, the moves are what? They're being squashed down. And what I'm saying is, for example, if we look here at Apple, and we'll go over to the option chain on Apple, it's going to have earnings this week. Right now, it's about a $5.23 expected move. Okay, so $5.23 expected move. But what I'm saying is, it appears that there's so many people selling premium today that it's actually suppressing volatility down, when real volatilities, okay, clearly are higher. They're exceeding the expectations. For the time being right now, for those of you that are like into earnings trades, because earnings, it's exciting. You know, it's like roll the dice over there like, oh, I just got beaten up. But I have never in my career seen a week of earnings where this many products move to either the edge of the expected move or outside the expected move. So much so that as the week progressed, I was out there buying premium. I did it inside of Microsoft with a butterfly outside of the expected move. Lo and behold, it worked. And it's something I'm going to be looking at doing throughout the remainder of this earnings cycle. Now, I'm not necessarily saying I'm just going to go buy a straddle out there. I may go, in fact, buy an iron condor. Now, Apple will be interesting because Apple, there's more skin in the game. There's more liquidity in Apple than really any other individual product out there. So I'm not sure Apple's going to have the big move, but we're going to be watching products like Google and Amazon and Facebook all in the coming, next 2 weeks over here for moves exceeding the expectations. Now, with that, let's put earnings aside for a moment. Again, the entire logic there, don't sell stuff into earnings right now. Clearly and decisively, it is not working. Now, back to the S&Ps, okay? The S&Ps, we've got 2-day options, 4-day options, 6-day options. That's a Monday, Wednesday, and Friday expiration. Why do I bring them all up? Because there's incredibly low implied volatility here. This is Monday, only expecting an $11 expected move. Volatility is going to pick up slightly as the week progresses, though. But again, extremely anemic volatility out there for the markets. So once again, what have we seen? Again, I'll reference this. Absolutely nothing from July, August, September, October. In terms of overall movement, we got a very, very shallow bout of volatility over here. Okay, I guess you can make an argument that the market is no longer moving higher at this point. Although, again, what a difference a couple of days can make. As the week progresses, some of the risks are going to pick up. We do have some GDP, some more economic numbers coming out. So keep your head up for that. But overall, earnings are going to take, again, kind of that center stage. In a market where the volatility is incredibly low right now, the earnings, that's where some of the excitement is. So we'll look at Apple as the week progresses over here. I also run a scan, quick earnings scan over here just to get a feel for what's up. Again, this is earnings, has earnings anytime, for instance, the next 3 days. Just a quick glance of kind of what's up to bat in terms of earnings this week. And again, Apple really takes that center stage. So thanks everybody for joining us here at TheoTrade in the weekend update. Keep your head up. If you're going to be in these earnings trades, you better know the vast amount of products have exceeded the expectations of movement. Thanks again for joining us here for the weekend update. Join us all throughout the course of this week in TheoTrade chat. Bye-bye.